Good evening, everyone, and welcome. Old Man Winter has struck again. The first day of spring is just 2 weeks from tomorrow, believe it or not, but springtime and warmer temperatures can't come soon enough for the recovering U.S. economy. Several reports out today blame last month's cold, bitter weather and unrelenting snow for a slowdown in economic growth in February. Far fewer than expected private sector jobs were added last month. Growth in the services sector of the economy fell to the slowest pace in 4 years, and it appears that white is the new beige, as the Federal Reserve's latest Beige Book economic survey reported that white, snowy, frigid winter weather had a major impact on hiring, manufacturing, and consumer spending. Steve Leisman has more on what it all means.
After ravaging the nation in snow and cold, the weather hit the U.S. again today, this time in a series of frigid economic reports that show the chilling impact of this winter's weather. A key gauge of the job market, the ADP National Employment Report came in at just 139,000, below the 160,000 estimated by Wall Street, and suggesting Friday's jobs report from the government could be soft as well. And a measure of the service sector, which makes up the bulk of the U.S. economy, fell to just 51.6, the lowest level in 4 years, in large measure due to the weather.
A lot of law firms couldn't practice because they couldn't get to the office and couldn't work. Accountants couldn't work. Retailers have been significantly affected, and it affects all the things that they do. So, in general, businesses just couldn't get the work done that they normally do.
Inside that service report from the Institute for Supply Management, a gauge of employment dropped nearly 9 points. The only bigger drop was during the 2008 recession. If that wasn't enough evidence that Mother Nature is having her way with the U.S. economy, the Fed's Beige Book, a collection of economic anecdotes from around the nation released today, mentioned weather 119 times. That compares with just 18 mentions a year ago. Among the mentions, rail cargo volumes in Dallas fell because of the weather. 9 districts of the 12 reported weaker manufacturing because of weather. Crops were damaged in the Richmond and Atlanta districts. Energy drilling declined in the Minneapolis district, which includes the oil-rich state of North Dakota. Hiring slowdowns were reported in Boston, Richmond, and Chicago because of the weather. On the upside, though, ski resorts in Richmond, Kansas City, and the Minneapolis districts, they had a good month, as did hotels in Atlanta and Boston because of stranded travelers. And there was increased energy demand that showed up in higher utility bills, but also softer retail and auto sales. For Nightly Business Report, I'm Steve Leisman.
Despite all the uncertainties about the U.S. economy, Josh Feinman's view is glass half full. He's chief global economist at Deutsche Asset and Wealth Management. So, Josh, it looks like we're now keeping score on how many times the Fed mentions weather in its reports, 119 times, as Steve just reported. We've been hearing that a lot. Is that really what's going on, or is it an excuse? Is something more fundamental happening with the economy?
I think that's the main thing that's going on here. We're all talking about the weather, and we saw it again in the Beige Book. It's sending a chill through people, through economic activity. There's little doubt about that. I mean, we can't be 100% certain that that's all that's going on. There is also a little bit of an inventory correction dampening activity here in the first quarter. But the key point is both of those things, the weather and inventories, should be temporary. I'm assuming that before long, I'm hoping, the weather returns to more normal. And the inventory correction will prove to be self-limited. And when that happens, I think the economy's improving fundamentals should, reappear.
Josh, how do you explain the rather sharp downward revision in GDP for the fourth quarter of last year? And that was really well before the worst of the bad weather hit.
It was. I mean, we had a little bit of the bad weather in December, but I think, some of that was we had a little bit too much of an increase in some of the early indicators, and they sort of tailed off a little bit. Some of that's weather, not all of it. But, overall, the economy did pretty well in the second half of the year. Keep in mind, the 2.5% of the fourth quarter followed 4% in the third quarter. So the economy did seem to be gaining momentum. It's lost a little bit of that momentum here, the weather, the inventory correction. But I think the improving fundamentals should reappear by the spring.
Josh, as you know, a lot of people are very concerned about the employment report that's coming out on Friday. And I know that you have a forecast that's not expecting too many jobs being added to businesses. How important is that? Tell us what your prediction is.
I'm looking for it to be, on the softer side. But I have to say, I think the bands of uncertainty around that are greater than usual because of the weather impact. We just don't know how many people were held out and couldn't get to work. because of the weather. We don't know how many of them will be off the payrolls, how many of them will just see a reduction in hours. So I think, unfortunately, the report is going to be obscuring the underlying trends, and we're just going to have to wait probably until the following couple of months to get a clearer picture.
Josh, how long will these weather effects continue to show up legitimately in the data?
Well, it depends on how quickly the weather comes back to something more normal. If we're assuming that we kind of get back to more normal temperatures and precipitations in March and April, then the data that start to print in April and May should look more normal. Actually, they could get a little bit of a bounce back. So we'll probably have to average through things for a few months before we get a read on the underlying trends.
All right, so how do you think this is going to play out with the Federal Reserve? They're having their first policy meeting with Janet Yellen in less than 2 weeks. If the numbers are weak in March, April, and May, what do they do?
Oh, well, right now, I think, they're just not going to have a clear handle at the meeting. So I don't think they're going to deviate from the script that they've been under, which is this gradual tapering pace. I think they're comfortable with that. They're comfortable with their forecast about the economy. And it's going to take a much bigger shift in their outlook to get them to veer off that path. But if we get into the spring and it turns out that this is not just a weather phenomenon, that the economy is downshifting more fundamentally, then by May, June, that type of time frame, then they would have to rethink. I don't think that's going to happen, but I think that's what it would take to get the Fed to veer off this course.
Thanks so much, Josh. Josh Feinman, Chief Global Economist at Deutsche Asset and Wealth Management.